Welcome to Spidell's Federal Tax Minute. I'm your host, Catherine Zidane, and this week we're covering short-term rentals and how to report the income. We'll be covering a number of real estate issues at Spidell's 2022 Summer Tax Webinar, along with retirement and investment topics. You can choose from available dates and times and get registered at spidell.com under the Webinars tab. With the surprising explosion of the real estate market the last couple of years, even through the COVID-19 pandemic, chances are you have more clients asking about the tax benefits of rental real estate. One aspect of rental real estate that has surged is short-term rentals, especially with travel restrictions being lifted, which turned this summer into the strongest travel summer since the pandemic, although it has also been marred by flight delays and cancellations. How rental income is treated depends on whether the host continues to use the residence between or during rentals or completely vacates the residence to use it for rentals only. If the host continues to use the residence, deductions are computed under the vacation rental rules. In contrast, if the host does not use the dwelling as a residence, then all expenses are deductible for the year or part of the year that the property was used or held for rental purposes, subject to the passive activity loss rules. And if a portion of the house is used exclusively for rentals, the hotel and bed and breakfast rules may apply. How the income is reported will impact which deductions can be claimed. If a taxpayer uses a dwelling as a residence during the tax year and rents the dwelling for 14 days or less during the year, the taxpayer is not required to report the income. And while they can't claim any deductions related to the rental, they can still deduct items that are otherwise deductible on their Schedule A, like home mortgage interest, property taxes, etc. For clients who are renting out a dwelling they use as a residence, either a room in their home or an entire home, for more than 14 days during the tax year, income received from the rental will be included in the taxpayer's gross income. Most taxpayers report this income on Schedule E, but if the activity rises to the level of a trade or business, the income will be reported on Schedule C. If the rental activities rise to the level of a trade or business, the taxpayer may also qualify for the qualified business income deduction under IRC Section 199A. Depreciation deductions can also be claimed for the rental portion of the home or for the days of the year the entire home was rented. The basis for purposes of depreciating a principal residence converted to a rental is the lesser of the adjusted basis of the property or its fair market value at the time of the conversion, after subtracting the amount allocated to non-depreciable land. Any excess amounts over the income limitation are carried over. Any depreciation claimed may be subject to recapture when the property is eventually sold or otherwise disposed of. We covered this topic in a recent article in Spidell's Federal Tax Letter, and the article included more information on the different types of rentals, examples, and a table of where to claim rental expenses. For more information on this monthly subscription, go to spidell.com and click on Publications. That's all for this week. Join us next time for another episode of Spidell's Federal Tax Minute.